Most of you know that the stock market gives better returns than treasury bills or even savings account. This is why we invest in stocks in the first place, right? But what many don't know is that most individual stocks don't produce returns that are higher than treasury bills or even savings accounts. Yes, you heard me right. The most common lifetime return for a stock is a negative 100. Today we're talking about the stocks that drive the stock market and how important it is that you don't miss out on owning these. And if there's one thing that everyone should know about the stock market, this is it. So that you can make more well-educated decisions about your future investments. This is Money with Penny, where we talk about personal finance in general and how the stock market really works in particular. Did you know that the stock market performance is driven by just a small amount of stocks? If you don't buy one of these high-performing stocks, you're gonna miss out on a lot of returns. In fact, when looking at the US stock market between 1926 and 2016, researchers found that only 0.36% of the firms, 1/3 of a percentage, account for half of the net stock market gains. These are the top 90 firms of over 25,000 that has been listed during this period. Or just about 1 in 300 companies listing on the US stock market exchanges has produced half of the gains. And hold on, because this gets even worse. Just 5 companies guys, are responsible for 10% of the wealth creation. 5 companies out of 25,000, with ExxonMobil in the top, responsible for just over 1 trillion or 2.88% of the almost 35 trillion in net wealth creation. And Apple coming in second with an additional 2.14% of wealth creation. Then we have Microsoft, General Electric and IBM. In fact, just over 4% collectively accounts for all of the net wealth creation in the stock market. This is just over 1,000 firms of over 25,000. This means that if you pick stocks randomly, you have 1 in a 25th chance of picking a winner. So if 4% of the companies drive the entire stock market, what about the rest of the 96% then? Well, they collectively generated gains that match those of 1-month US Treasury bills, which have returned just over 1% yearly long term. Yeah, this is when we looked at all of these 96% together, because most of them actually ended up with negative lifetime returns. So what does this all mean? While the US stock market overall, meaning all the stocks collectively, have outperformed treasury bills in the long run, most individual stocks have not. And the most common lifetime return for a stock was actually a 100% loss, which happened to 12% of the stocks. A lifetime that was just over 7 years in average. So if you're planning to invest into the same stocks long term, maybe you have to reconsider. So now I've been throwing around a bunch of numbers, and it might not be completely clear what this means to you as an investor. So let's take a look at a simple example of what this means. Imagine that we have a stock market with 5 stocks. Together these 5 stocks would constitute our index. So when we look at them all together, when we look at their performance all together, we can determine how our little stock market is doing as a whole. 4 of the stocks will return 10% and 1 will highly outperform and return 50%. Now some investors want to buy our stocks, and suppose that they compose portfolios of 1 or 2 of these stocks. Then we get a total of 15 possible portfolios. Of these, 10 portfolios or 2/3 will return 10% because they only include stocks that will return 10%. Just 5 of the portfolios will include a winning stock and return 30 to 50% depending on if they only contain the winner or the winner and one of the stocks returning 10% as well. Now when we look at all of our stocks together, our index, the average return of the whole stock market is 18%. Even so, most of the portfolios will underperform the average, as the average is elevated by this one higher outlier. And this is exactly what we see in the historic stock market data as well, where 4% of the stocks have driven the entire stock market wealth creation. And I believe that this effect will only get greater in the coming years, as new listings has tended to be riskier and with lower profitability. So to understand the sheer magnitude of this, have a look at the performance of Amazon, for example, that between 1999 and 2017 returned a staggering 35,000%. Huge congrats, Jeff Bezos. And during the same time period, the S&P 500 returned 181%. These enormous returns of Amazon did of course have a great impact on the returns of the index. And imagine the returns of S&P 500 if Amazon had not been added. It would have been much lower, of course. Here you can see the returns of the S&P 500 in the 20-year period between 1997 and 2017. The plot shows how many percentage of the stocks that produced a certain return during this period. The median shows us where the middle value is, so under this we find 50% of the stocks and over this the rest of the 50%. As you can see, the average is way above the median, which means that less than half of the stocks has produced greater returns than the index. And 30% of the stocks didn't even produce positive returns. And the longer time period we look at, the more skewed this will look, as the most prolific stocks will produce even higher returns because of compound interest. And this in turn will push the average even higher, with the effect that fewer and fewer stocks will eventually have beaten the index. This is because a stock can obviously only fall by 100%, but it can, at least in theory, rise infinitely. Effectively, this means that selecting a small number of stocks in your portfolio will maximize the chances of beating the index. But this will also maximize the probability of underperforming the index. And as you saw in the example, the chances of underperforming is much higher than the chances of outperforming. The more stocks that you include in your portfolio, the higher the chances of actually picking the winning stock and beating the index, but the less is the possible return. This also means that it's not only challenging to beat the stock market index by stock picking, but also just to keep up with the index. And this is one of the reasons why active fund managers are having so much trouble beating the index consistently. Now, this is a study on the US stock market, but the same study has also been performed globally with similar but actually slightly worse results. But hey, maybe now you're thinking, okay, so you tell me it's challenging to beat the index, but there is still a slim chance of doing it, and I can probably find those outperforming stocks. How hard can it be, right? And even if you don't think so, most of us will, because most of us tend to think that we are better than the average. The huge problem is just to find these stocks beforehand. Maybe you think it's just to buy some of the FANG stocks and you'll be all set. Let's take a look at which stocks drove the stock market during the last decade and see if these are all easy picks or if some of them might even surprise you. This graph shows what you would have had in the end of 2019 if you would have invested $100 in the beginning of 2010 into these individual stocks. On the first place we have Netflix, which maybe doesn't seem too surprising. And we can see some other household names on the list, such as Amazon, Constellation Brand and MasterCard, for example. But on the second place, Market Access, would you have guessed that? This is a fintech company that operates a global electronics bond trading platform. And in third place, we have the medtech company Abiomed that develops medical devices for circulatory support. Hands up if we would have been able to spot those. Let me know in the comments, guys. And it's also worth noting that picking the winning stocks has only become more and more challenging. The market that used to be made up of most retail investors, like you and me, are now mostly made up of professionals. And these are educated, smart people with PhDs, MBAs, CFAs and whatnot. And they are having huge problem picking the winning stocks. And they have huge resources and teams of people devoting their entire workdays on analyzing companies and the markets to find the smallest advantages. And they even have extra fast internet, so they can act a millisecond faster than others on micro mispricings. But with all the information out there, so easily accessible these days, the smallest incorrect pricings will soon be corrected. But it's not only these educated, smart people you're competing against. Now there are also super fast computers and algorithms coded especially for this. And remember that every time you buy or sell a stock, there's someone on the other side of the trade that has got the opposite opinion. Next time, ask yourself, what do they know that I don't? So what can we learn from this? The whole reason that stocks return more than treasury bills, it's not because all individual stocks do so, but because a small number of stocks produce these very high returns. So the returns from stock picking can be very large if you're either lucky or skilled enough to select a concentrated portfolio containing stocks that end up producing these extreme positive returns. For example, if you would have gone all in on Amazon in the beginning of the century. And remember that you have to find tomorrow's Amazon, because in hindsight, it always looks easy. The key is, of course, whether you can really do this, or if you can identify a fund manager that can, or if it would have been better to simply invest in an index fund instead, which will guarantee that you get the winners and beat the majority of the individual stocks. With this said, guys, there are still some possibilities of beating general indices, and this I will talk more about in upcoming videos. Continue watching these videos appearing on the screen right now or in the description below to learn more about personal finance and how the stock market really works. And don't forget to subscribe and hit the bell. This will help me out tremendously, guys. And as usual, references can be found in the description below. Thank you so much for watching all the way to the end, and see you all next time.